Welcome to CoreLogic's housing market update for June 2023. Our national measure of home values recorded a third consecutive rise last month, with the pace of growth accelerating sharply to 1.2%. After finding a floor in February, home values nationally have increased by 2.3% in the 3 months to May, following a 9.2% drop. Sydney continues to lead the recovery trend, posting a 1.8% lift in values over the month. That's the largest monthly gain since September of 2021. Since moving through a trough in January, home values have risen by 4.8%, or by roughly $48,000 in dollar terms. Brisbane and Perth were the only other capital cities to record a monthly gain of more than 1%. However, the rise in values through May was broad-based, with the rate of growth accelerating across every capital city. The positive trend is a symptom of persistently low levels of available housing supply running up against rising housing demand. Advertised listings trended lower through May, with roughly 1,800 fewer capital city homes advertised for sale relative to the end of April. Inventory levels are 15% lower than they were at the same time last year and 24% below the previous 5-year average for this time of the year. With such a short supply of available housing stock, buyers are becoming more competitive, and there looks to be an element of FOMO creeping back into the market. Amid increased competition, auction clearance rates have trended higher, holding at 70% or above over the past 3 weeks. For private treaty sales, homes are selling faster with less vendor discounting. The trend in regional housing values has also picked up, with the combined regionals index rising 0.5% in May, following a 0.2% and 0.1% rise in March and April. Although regional home values are trending higher, the rate of gain hasn't kept pace with the capital cities. Over the past 3 months, growth in the combined capitals index was more than triple that of the combined regionals, at 2.8% and 0.8% respectively. Although advertised housing supply remains tight across regional Australia, demand from net overseas migration is less substantial. Historically, regional Australia accounts for around 15% of Australia's net overseas migration. Additionally, a slowdown in internal migration rates across the regions has helped to ease the demand-side pressures on housing. Premium housing markets in Sydney continue to lead the recovery trend. After recording a larger drop in values, Sydney's most expensive quarter of the market stands out with the highest rate of growth, gaining 5.6% over the past 3 months, compared with a 2.6% rise in the more affordable lower quartile values. Interestingly, buyers targeting the premium sector of the market are still buying at well below peak prices. Although values across more expensive homes are rising more rapidly, at the end of May, dwelling values across Sydney's upper quartile remained almost 12% below the January 2022 peak. That's the equivalent to a saving of around $213,000 from the cyclical high. The same can be said for other housing markets. In fact, despite the recent gains, most capital city markets are still recording housing values that are well below recent peaks. Perth is the only capital city where dwelling values have returned to record highs. At the other end of the spectrum is Hobart, where values remain the lowest relative to the city's recent cyclical peak in May last year, down 12.6%. While advertised supply remains well below average, home sales have shown some subtle upwards movement, with the number of capital city dwelling sales rising over the past 3 months to be the highest level since July last year. While capital city home sales are well below the recent highs recorded in late 2021, they are roughly in line with the previous 5-year average, with the number of home sales outstripping new listings in the past 3 months. With selling conditions improving, we could see more homeowners test the marketplace. The flow of new listings is normally subdued through the winter months before trending higher into spring. It will be interesting to see if more vendors take advantage of the improving housing market conditions and look to beat the spring rush when competition to sell could be more intense. Adelaide housing values were up 0.9% in May, the second consecutive lift in home values following 8 months of decline. With the market up 1.2% since March, Adelaide home values were only slightly off record highs, reflecting only a relatively mild downturn in values through the interest rate hiking cycle to date. Relatively affordable housing prices, especially for interstate buyers, and tight stock levels are key factors supporting the upwards pressure on values. Adelaide's median dwelling value, at $655,000, is the third most affordable of all the capitals, ahead of Darwin and Perth. With housing values moving through a third month of growth, it's clear the market has moved past a short but sharp downturn. Capital City home values dropped 9.7% in the space of 10 months. Not quite the largest drop on record, but it was the sharpest. Since finding a floor in February, Capital City home values are up 2.8%, but still 7.1% below their peak in April 2022. The recovery trend is looking increasingly entrenched based on the past 3 months. However, the outlook for housing remains highly uncertain, given the possibility of further rate hikes, the potential for higher levels of mortgage stress, and persistently low levels of consumer sentiment. The upwards momentum in housing prices may induce a renewed wealth effect. If households are feeling wealthier, they could be inclined to spend more, which is an upside risk for inflation. While trends in housing markets fall well outside of the Reserve Bank's mandate, is highlighted by the Reserve Bank last month, rising asset prices need to be considered with respect to inflation. This trend towards higher housing values could be a factor placing upwards pressure on interest rate decisions. If interest rates do rise further, it remains uncertain if this would be enough to reverse the positive trend in housing values. While higher interest rates might quell some of the demand-side pressures as borrowing capacity and sentiment reduce further, demand from record levels of net overseas migration will remain. With rental vacancy rates remaining close to record lows and listing numbers well below average, it's hard to see where this additional housing demand will reside without a material and immediate supply response. Another risk relates to the potential for increased mortgage stress. The coming months will see a sharp rise in the number of fixed-rate home loans reaching term. As more borrowers refinance, we should get a better understanding of how well borrowers are placed to service their debt at a substantially higher interest rate. Helping to offset these risks are tight labour market conditions and a healthy level of household savings accrued. With labour markets expected to remain tight, the risk of distressed selling should be contained. Despite rising to 3.7% in April, unemployment continues to track around generational lows, well below the pre-COVID decade average of 5.5%. Public and private sector forecasts have the unemployment rate rising, but remaining well below the decade average benchmark. The outlook for housing markets largely rests with the trajectory of interest rates. Economists are divided on the cash rate outlook, highlighting the sheer uncertainty about whether we have moved through a peak in the cash rate cycle or not. Even if the rate hiking cycle is over, the timing of a rate cut also remains highly uncertain. Once interest rates start to reduce, we could see more sustained momentum gather in housing markets. One certainty is that we will always see a great deal of interest in housing markets here in Australia. To keep up to date with all the twists and turns, you can tune into the research pages at our website, corelogic.com.au.